Now, what I'm going to do is give a quick summary of what happened in the crisis, just with as little analysis of why it happened as possible, just descriptive, and then look at some alternative ideas about why it happened, addressing the question of whether the problem was caused by too much or too little regulation. Of course, that's a slightly false. You might argue that it wasn't too much or too little, just the wrong kind of regulation. And I'll get on to what the regulatory proposals are now and what effect they're likely to have. Now, so what happened is that, so what caused the crisis? I'm not going to talk about why property prices in America got so high. We can come back to that if you want during the question period. But what happened is that property prices began to decline. Again, we can discuss why they declined. Same problems why they got so high. But they began to decline. Now this causes losses for banks in two ways. One is directly, that's to say if you're a bank that has lent money to people who have borrowed to buy a house. In America especially, when the value of the house declines, default rates go up very fast. Because in America, almost all mortgage lending is what's called non-recourse lending. That's to say, if you're the bank and you've lent money, you've given a mortgage on the house, you can earn, the only asset that you can chase the borrower for if they default is the house. You have no recourse to anything except the house. Whereas in the UK, if you default on your mortgage, the bank can also take your car, everything else you've got. And so in America what happens is once the value of your house declines below the mortgage, the amount of the mortgage, it's in your interest just to walk away. The bank will take the house, you're better off. They can't chase you for the excess value over and above the house. So as the house prices drop, the default rate on mortgages goes up, banks start losing money on that. More importantly, however, in the US, and it had always been the custom, and then globally it became the custom, that banks would package mortgages into securities known as mortgage-backed securities. If you want, we can talk about what mortgage-backed securities are, how they work and so on, but what matters here is that a mortgage-backed security is, it's like a bond, and it pays out interest to the holder of the bond because there's money coming in to the bank that's issued the bond from the mortgage. It's linked to a bunch of mortgages. Now, as mortgage default rates start going up, the value of these bonds starts going down fast. So they're sitting on the bank balance sheets. So these things depreciate very fast, even given small increases in the default rate. Now, this has a kind of unpleasant feedback loop given the accounting rules for banks. So banks have to hold a certain, they've got a balance sheet. Just I'll make it very simple. The balance sheet of a bank is its assets, so let's say all the money it's lent out. Its liabilities are a combination of the equity, the shareholder's equity, and the money it's borrowed. So debt and equity. Now, if they're, as in the US, if a lot of their assets are actually in these securities, in mortgage-backed securities, as they devalue, that's eating the assets. The liability, their bank's liabilities aren't going down. So as the assets go down, the equity is being eaten up, the capital, and it will soon fall beneath the legal required minimum, and the bank is technically insolvent. So what do the banks have to do? Well, they have to sell off these devaluing assets to raise cash. That actually accelerates the devaluation of the assets because they're all coming into the market, and you've got a vicious cycle being created. Banks desperately trying to improve their capital situation by shedding devaluing assets increases the rate at which the assets devalue, and you've got a systemic problem. That then was spread globally because a lot of European banks are holding these assets too, these mortgage-backed securities are beginning to devalue. They're becoming, that these banks, their solvency is being threatened. And then, because the banks don't know exactly what each other has got on their balance sheets, they become nervous about lending to one another. In the United States and Britain in particular, where there's a negative savings rate, that's to say the population borrows more than it saves, that banks largely fund their operations in the wholesale market, the interbank market. So they're picking up funds from other banks. Often the net input of the funds is coming from other countries, not Asian countries and so on. But this market, the interbank market, seized up at the point when banks became very worried about each other. They didn't know if these banks were really secure. They didn't want to lend to each other anymore. And that's when things came to an absolute head in late 2008. And potentially there was a major economic crisis, not just a problem for banks, but because now people talk about the payment system. It's important to distinguish two things. So people said there's a potential calamity here in the real economy. There's going to be people aren't going to be able to pay their staff, people aren't going to be able to banking transactions are going to stop. Now, that may confuse you, because we're talking about a problem of banks lending to each other, why should the mechanism of transferring money between people into their bank accounts seize up? Well, one of the reasons is that a lot of payments in the real economy are based on credit. So for a huge number of companies pay their staff actually on credit. They've borrowed money from the bank to pay their staff. They've got a kind of rolling facility that allows them to just go, they're doing it on credit. They're operating on a day-to-day basis on credit. Now if that seizes up, suddenly you're not getting your paycheck, you can't buy your groceries, and there's a calamity. So this is what everybody was worried about, and hence, in theory, the government interventions, the massive provision of liquidity into the market, lending banks in the United States through the TARP program, all this money in Britain pumping directly equity in, so providing banks with the capital that they required to remain technically solvent. The other measure that was very important at the time of the crisis was the provision of guarantees for deposit holders. Now in the UK, I think it was up to, someone can correct me, I think it was up to 30,000. The standard deposit was 30,000. In the US, I think it was 125, maybe it was 250. Anyway, they extended it in the US. In Britain, they extended it completely, right? So there's no cap. It covers even now interbank lending. Interbank deposits are now government guaranteed. So if you're a bank and you deposit money with another bank, that's government guaranteed. So that was, there were two reasons for that. One was, of course, to unfreeze the interbank market. They could trust each other because now they're really just trusting the government. And the other thing was to protect retail deposits, ordinary people's deposits, to trap them locally. Because Ireland, the Irish government, when their crisis extended guarantees, took off the cap on guarantees. And the immediate response was a lot of British people started transferring their money to Ireland, where they didn't have to worry about, they were lending money to the Irish government, which is pretty safe considering Ireland's part of the EU. So the British government removed the cap here so that they'd keep retail deposits in Britain. And I'll get back to one of the developments that's occurred post-crisis, which hasn't been much commented on, is the deglobalization of bank funding. I'll get to that later when we talk about the new regulations, but a lot of the short-term government actions and some of the regulations that are being planned for the long term will have the effect of forcing funding of banks to be done locally. So banks will have to sort of get their money. They can't get it from the global interbank market. They'll have to get it locally. Okay, so that's a brief description of what happened. Now, the way I'm going to discuss the question of markets versus regulation is by starting with the question, explaining why it shouldn't have happened in free market theory, and then, so we'll set up this model, how should the market really work, ideally, and then let's ask, why didn't it work like that? And I'll look at what regulations just got in the way of it working like that, or maybe there are kind of inherent market failures that stopped it working like that, and we really need regulation to help overcome them. So let me first, as I say, explain how things should go in theory in terms of risk in the banking market. Now, a bank lends money. am I going to do this best? I'm a bank. You're a borrower. Now, if I lend money, if I, as a bank, lend you money, I'm taking a risk. And the people who invest in the bank, they're carrying that risk, right? So if you've lent money to a bank, or you're a shareholder of the bank, if I'm lending, you stand to lose if the bank lends to people who don't pay the money back. Now, any bank, the risk, so I'm going to just talk about the bank, and by the bank in the short term I mean the shareholders of the bank and the people who lend money to the bank. I'll distinguish between them soon, but let's just talk about the bank. Now, as banks can take, I'm going to simplify again, but roughly there are two ways that the bank can increase its riskiness, the risk it's taking. And I'll just focus on lending. There are other things they can do, but I'll just focus on lending to keep things simple. They can lend to riskier people. So suppose I've got, I'll just use the board, sorry, that's going to, don't worry. Suppose I've got, here's a bank balance sheet, there are the assets, there are the liabilities. Now let's suppose I've got, they must equal each other, it's a balance sheet, and let's suppose that's 10% and that's the equity. Okay, so this is, I've lent out $100, I've got $10 of equity, and I've got $90 of debt. So that's how I'm funding these assets. Okay. So this is money that's been lent to me by either retail depositors or by people who bought the bank's bonds. This is the shareholders' capital, and here's the loans. Now, I can do a few things. I can, for any given level of riskiness of these people, so let's suppose I'm lending to the, we'll take the American government, their theory risk-free. Let's suppose, we'll take government. Let's suppose we're lending to the New Zealand government, my government. Now, that's not risk-free. Right? Now, I can increase my risk. I'm just still lending to the New Zealand government, but I can just do more of it, and I don't increase that. So I go up to 140 here and 150 here. So I've increased the risk. Right? That's a riskier position than it was at 100. It's riskier because if these guys don't, suppose I lose 10% of this, that's 15 I've lost, and I've come down, I'm going to eat into more of my equity. In fact, since these guys aren't going to take, I've lost all my equity now. Right? I've lost $15 here, I've got 140 of debt, I've got to pay that back. The only money that's really mine is the 10 here. If these go down by 10%, I've lost 15, and that's wiped me out. Whereas at 100, if they went down 10%, I've only lost 10. I'm not as wiped out. Right? So that's one way I can do it. This is so-called leverage or gearing. So you hear about the leverage ratio of the banks. Lehman Brothers, before the crisis, got up to a ratio of 40 to 1. So that's to say, for every one, that was 10, and the total was 410. Is that right? Yeah. No. 400. I think it's right. Yeah. There are two ways of doing it. You can see one you add on. So it's, anyway, that's one measure. The other thing that I could do though is I just lend to riskier people. So I've still got 100, but I'm not lending to the government of New Zealand anymore. I'm lending to Papua New Guinea. So it's still 10 and 100, but this is much more likely to default, and so it's much riskier. Now, here's what should happen. As I do either of those two things as a bank, and I'm supposed to take more risk, my cost of what's called, I don't know how much you guys will know about finance. Some probably know a lot, some probably don't know so much, so it's boring for the ones who don't. Something called the weighted average cost of capital. So this is debt capital, this is equity capital. Equity capital is more expensive than debt capital because you lose the equity. People who put in the equity lose the money first. They want a higher return. Debt capital is cheaper, but on average, the average cost of these combined will go up as the riskiness over here goes up. Right? So as I'm taking on more risk, either by increasing my gearing, by my leverage ratio, or by lending to riskier people, what will happen is the people funding me as a bank will demand a higher return on it, because they're taking more risk by giving me this money. And if you think of it marginally, I'm thinking, well, I've got my next increment of lending. I'm going to take a little bit more risk, but I have to pay to take that risk. And I should get to a point where the cost of taking the risk exceeds the return I can get from taking that risk, and that will, at that point, I won't do it anymore. That's the natural limit of my risk-taking. So, if everything's working properly, the cost of funding my risk-taking operations will go up and up and up, and I'll keep doing it until the return I get on my risk-taking activities is smaller than the cost of doing it, and then I'll stop. Now, that's the rough theory, right? But interestingly, it simply did not work before the crisis. So if you look at people like, all the major banks that collapsed, their weighted average cost of capital did not go up during that period. They were taking on more and more and more risk, and yet the cost of taking on that risk didn't increase as you would expect it to. So the normal market mechanism for constraining risk-taking was not working. And the question is, why not? Now, and that's where we get to the point of this talk. Was it that there are regulation-caused distortions to the market that prevented it from happening? Or is it for some inherent failing in the market for risk? So some commentators say, the market doesn't work in risk. I've read that in the FT by commentators. They say, in theory, market's great, but not in risk. You can't. And that's not completely implausible, because, and I'll get to that. Now, before I go through, what I'm going to do is I'm going to go through and look at the market distortions. There are a lot of regulatory distortions in the market. My view is that they do explain, that they go quite a long way to explaining what happened, but they're not completely satisfying. And I think that there's something left, which may be kind of unavoidable human failure. And risk isn't, as Taleb has pointed out, risk is a bit different. It is difficult to price accurately. So, but even acknowledging that, the real question is a regulatory solution better than a pure market one? So my view is that you're inevitably going to have a certain amount, you're going to have some, I hate the expression market failure, but you're going to have some things going wrong under the market system. It doesn't follow from that there is a good regulatory remedy. Right? So my view is that some of what people say who are hostile to the market solution is correct factually, they're right, that is, they're not wrong about the facts and what went wrong. But they are utopian, foolishly utopian in thinking that there is a regulatory solution to these problems. And when I get on to look at the new regulatory proposals, I think you'll see just how correct. I mean, some of the ideas blowing around at the moment are close to this. All right, now, it's a quick list of the market distortions. The most obvious one are deposit guarantees. So if you lend your money to a bank, you don't have to, nobody even thinks about the sole security of the bank, unless you've got an awful lot of money. But most people, most retail depositors, exercise more judgment in their selection of a coffee shop than they do of the bank where they're going to place their savings, which is a remarkable fact. Well, it's not that right, it's obvious given that there are guarantees, but the point is that it means that retail deposits, banks will pay no more for the retail deposits that they gather. It doesn't matter how much risk they're taking on the other side, they can always get them at the government guaranteed rate. So that stops a price signal for risk coming to the banks. They've got this cheap source of funding because the government guarantees them. Then there's the implicit guarantee to the bondholders. So in theory, the explicit deposit insurance guarantees are only for the retail deposits, only up to a certain limit. But everybody kind of knows that if a bank folds, they'll pay out the bondholders. The reason they kind of know that is because the major holders of bonds are insurance companies and pension funds. And if the government had let the bondholders in the UK, the bank bondholders, take a hit, that would have gone directly into the pension funds and then through to retirees, and the government would have ended up bailing them out. Right? So they might as well, if you're in the bailout game, which the government is, at some point, the question for them isn't are we going to pay up? It's when, at what point in the chain are we going to pay up? And it makes more sense to pay up. You understand, I'm making a contextual point here. Given where they're sitting, it's better to stem the bleeding at the source. They'll just pay up later anyway. So that's why everybody holding those bonds knows the government bail them out. So the bonds, so this whole bit here, this whole part of the cost of funding their operations for banks is risk insensitive. Doesn't matter how much risk they add here, the cost of this bit won't change. And that's why, of course, they got so hugely leveraged, because this money is coming in at a government guaranteed rate. So you want to keep that to a minimum, because this is pricey. You've got to pay a kind of market rate for that. This is government guaranteed, so that's why you get these 40-to-1 gearing ratios, because it's a really cheap way of funding the source of your income over here. Right, so those are clear distortions to risk, market risk pricing. And they allow banks to work, to develop huge amounts more risk than you normally would expect. A few other, that's the main, I think that's really the main driver. But there are some other smaller details. Now, what is solvency regulations? There's a whole framework called Basel, the Basel Accord, about banking solvency, which tells you two things basically. It says a bank must hold 8%. This must be 8%. That's the minimum requirement. But it's 8% of what they call risk-weighted assets. Risk-weighted assets, gets back to that point I was making before about the difference between lending to the New Zealand government and lending to the Papua New Guinea government. $100 lent to the New Zealand government is safer than $100 lent to the Papua New Guinea government. So if I've got to hold $8 in capital as a kind of buffer, a protection against the possibility of default, it would be crazy if I had to hold the same amount against the New Zealand government as against the Papua New Guinea government. So what they do, what the whole Basel II framework did, it says, let's risk weight your assets. So if you're lending to the US government, the risk weighting is 0, or close to 0, it's not exact. I won't bore you with the details, but they are not going to default. It's not going to happen. It's so unlikely to happen that you don't have to, you can call it $100 to them, you can call it $1. So you have to hold 8 cents. If you lend money to a Nigerian taxi company, you need the whole $100. In fact, they might risk weight at 150 or more, so you might have to hold. In fact, they moved to fully flexible. I won't explain all the details, but the point is, it's risk adjusted. So these regulations specify the rules for risk adjusting the assets, and then specify a proportion, an amount of capital you've got to hold against risk-weighted assets, which was 8%. And it also rules about what counts as capital and what doesn't. Technicalities won't bore you. Now, why do these rules distort the market? Well, there are two reasons, really. One is what's known, you've probably heard the expression, regulatory arbitrage. So there are all these rules, right? And they're always about, this kind of risk has got to be measured in this way, and you've got to hold this kind of amount of capital against it, and so on. And what you'll find is that the picture that even the most clever and brilliant regulator comes up with is incomplete and incorrect in various respects. So that you can find an activity that you take two activities with the same official riskiness, that's the same risk weighting, yet one is in fact riskier than the other and yields a higher return. So one thing that's worth bearing in mind during this discussion is that the more risky an activity is, the higher return it is to the bank. Now, if you've got a regulatory environment in which I've got to hold, what I'm trying to do is optimize my return on capital, then if I've got to hold the same amount of capital by the rules against activity A and activity B, and activity B is in fact riskier, and therefore in fact has a higher return to me, I will prefer B to A, right? Because I get a higher return on capital. So the perverse effect of regulatory capital rules is that they make me, all things being equal on capital, I prefer the riskier one. Now, so what banks do is this is called regulatory arbitrage, they look for activities that the rules don't properly capture the risk of, and they divert their resources there. So it's kind of a game of cat and mouse, where the cat is driving the mouse into ever riskier nooks and crannies of the market, because where they can't be caught, and yet they can make some money. So I'm getting a bit ahead of myself here, but the dream is that we'll have perfect regulations and this won't happen anymore. But that is a utopian fantasy. In fact, I can tell you that there's a guy who used to work for my company, I can't name him or the bank he went to, but he now runs a part of the bank which, if it were accurately named, would be called the Regulatory Arbitrage Division. His job is simply to find opportunities to exploit the capital regulations, and that's what he does. And the bank's capital ends up being directed, the resources of the bank go in those areas. The other effect the capital regulations have, which is perhaps more subtle but really quite profound, I think, in the end, is that it creates an environment of what I'll call a compliance mentality. All of the banks that defaulted were complied with the regulations for solvency. They all complied with the Basel II regulations. In fact, they all had capital well in excess of the requirements of the rules. Way in excess, in fact. All of them had about 50% to 100% more capital than was strictly required. And so if you're on the board of that bank, you're not, board members of banks are not necessarily the most, they're not rocket scientists when it comes to risk, right? They might have had a stellar career in groceries or something. And then they get a report from the risk division that says we're comply with the Basel, we've got the capital levels that we're required to have by law, and they're fine. It's all fine. I can give you some anecdotes later on. So everybody thinks this stuff is looked after by the law, by these rules, and we've got a division of the bank that makes sure that we're complying with the rules. I just want to see that box ticked, and then everything's fine. But actually, that makes you terribly complacent about the real risks that the bank is running. So these rules have not only directly perverse effects, but they kind of create a certain complacency in the senior management. I'll mention two other things very briefly. One is that Fannie Mae and Freddie Mac, the mortgage, what they do, not everybody knows what they really do. What they do in the States, they were set up to encourage the mortgage business in the US, to help people get into homes. And the way they do that is that you're a bank, you've got I'll use this again. You lend somebody $10. No. You lend somebody $10, and it's on your balance sheet. There's your $10, and you've got this, and you've got to put $1 of capital by it. You've only got $10 of capital, right? You think, no, I can't make another loan, right? I've used up all my capital. I've got all these loans in my book, and what am I going to do? Well, you're going to either have to get more capital so you can make more loans, or if I could just sell that to somebody, then I free up my capital and can make another loan. And banks actually make a lot of their money there are two sources of money when you make a loan. There's the money that you get for keeping it on your balance sheet, so to speak, and just the difference between what you pay for these funds and what you charge for these. But there's also a certain amount of money that's being paid to you tacitly for the cost that you bear in originating that loan, finding the customer, doing all that kind of thing. Suppose I make $100 from a loan. Probably the interest margin on the loan, that's to say, if I sold the loan on, I'd lose, say, $70, but I'd keep $30. That's kind of implicitly what I'm being paid for the fact that I went out there and found a customer and did all that. So someone who doesn't have to do that, doesn't have to have a branch network, doesn't have to do all those things, would be willing to pay $70, and I get to keep the $30 of income. And the great thing is I free up my $1 of capital here, and I can make another loan and make another $30. This is called capital velocity in banking, right? So I want to keep churning. It's much better to make $30 10 times in a year than make $100 once every 5 years. So I want to get these things off my balance sheet. Right? That's this expression you probably hear, getting things off your balance sheet. The reason banks want to get things off their balance sheets is so that they keep making this 30 over and over and over. Now, Fannie Mae and Freddie Mac were set up to allow banks to do that. So if you've got a Fannie qualifying or Freddie qualifying loan, which means that there was a certain credit quality, a certain likelihood of being repaid, they'll buy it off you. Fannie Mae will buy it off you, right? So they pay that you give up the 70, you keep the 30, and it's now on their balance sheet, not yours. Then Freddie Mac would bundle it up into these securities, these mortgage-backed securities, and sell them into the general market. So in the States, a lot of the securitization was going through these two institutions.
95% in 2006, 2007.
Good. And then the UK was being done, the banks started doing it themselves. Right? So they started bundling them up with the UBS and so on. Now these institutions were set up for this purpose, and because the government wanted to promote home ownership in America. But they gave them, they benefited from government guarantees implicitly. So an implicit government guarantee, and actually they only had to carry 4% capital. They got a discount on the capital. So they didn't bear the full cost of the risk they were taking. So in terms of subsidies for risk, if you want to sum it all up, there are all sorts of subsidies for bank risk-taking. The fact that these deposits, the implicit guarantees in banks' liabilities, and then Freddie Mac and Fannie Mae were subsidized. So you've got all the subsidy of risk-taking, especially around mortgages.
One other little thing, on that, just a statistic, Fannie Mae and Freddie Mac traded their bonds were 0.5% below the general rate of AAA rated, other AAA rated companies, so it's obvious that...
Well, that's proof, yeah. That's perfect proof. So you see how cheaply they can fund their risk-taking activities. Well, I won't go into that because... now, one final point about market. The other market distortion is something that was discussed a lot at the beginning of the crisis, but not so much now, is the fact that these mortgage-backed securities were AAA rated, many of them, even though they went on to lose a lot of their value, a lot of the loans that were packaged up in them defaulted. How could they be AAA rated? And they were AAA rated by these rating agencies. And the really interesting questions about why the rating agencies got it so wrong. I don't think it is wholly a matter of regulatory distortions, but there is one regulatory distortion to be noted, which is that they are a regulated cartel. So all of these securities have to be rated by a so-called approved rating agency, and only 4 are approved. So that meant there was far less competition than you would normally expect amongst rating agencies. And the volume, I mean this is completely right, the volume of work that they had during the boom was so enormous that they really just couldn't handle it. And so they're bringing lower and lower quality staff in, they were rushing things. And there's a lot of evidence also that there's so-called Chinese walls within these organizations, which separate. So in theory, if you're doing the rating of the asset, of the security, you shouldn't know who the client is. You should have no commercial concern, right? Because that would encourage you to give it a better rating than it deserves, because you want to give the business. So in theory, the credit analysts who did that rating work were working blind. But a lot of evidence emerged that they really weren't. There were some emails found saying things like, I'm not sure about this security, but I know they're an important client. Do you think I should maybe give it a AAA? Things like that. Okay, now, that's all. That would make us all very happy as free marketeers, except for one lingering problem, which is that even given all of that, why didn't the cost of equity skyrocket? So here you are, you're a shareholder in a bank. Because debt comes government guaranteed effectively and the cost of it doesn't go up, they're starting to leverage up through the roof. Right? They're going huge amounts of debt, huge assets. Given this high levels of leverage, let's say I'm at a nice round number, let's say I'm at 50 to 1, right? So I've got, if I only need to lose, so I'm at 500 there, right? So I only need to lose a 20th. Yeah, that's right. A 20th of, no, it's not even a 20th. What is it? What's 10 divided by, it's 2%, isn't it? Yeah, 2%. So if this devalues by 2%, I've wiped out my capital. And if you're the shareholder, that's it. You're finished. Your shares are worthless. So this leverage is going on. You've got up to enormous levels of leverage. It takes only a tiny devaluation of the assets, and the capital value of the bank has been wiped out. You would expect, would you not, that the cost of equity capital would be going through the roof. That's to say, people will be demanding extremely high returns on this, or alternatively, which is the same round, they'd be selling their shares, and the share price would be going through the floor. That's what you'd expect, right? And nothing I've said, so the government can do all these things, guarantee all this. Why is the market not responding as you would expect in that area? And this, to me, is a real puzzle. I don't, to be honest, really know, and I haven't heard a completely convincing analysis of this. Now, I think I'll go quickly through some possibilities and just give you an opinion, my kind of relatively uninformed, I must confess, opinion. And maybe we can discuss this. Now, okay, so the first one, and the kind of anti-market analysis, is that it's animal passions, irrational exuberance, all these kinds of things that mean that human beings can't be trusted in a market situation. And there may be an element of truth in that. But I like to think, Americans in particular, Americans here, seem to be very vulnerable to the idea that it's a whole new world. Right? The old rules of finance don't apply anymore, and we don't have to worry about things like 50 times leverage. That's old world thinking. Now, I'd like to find a cause for why that might strike people as a plausible idea, rather than seeing it's just an idea out of nowhere. But so there may be some truth in that, right? I think there is a bit of an explanation which I'll come to. The other one is, and I think this is a real explanation as well, and this is the kind of Nicholas Taleb points, which is that it's true that risk, especially so-called tail risk, which I will explain in a second, is very hard to observe. It's very difficult to know what the real risk of. So I say, it's a 2%. It only takes a 2% devaluation on the assets and have wiped out the capital. Well, yeah, okay, but what is the chance of that? If the chance of that is 0, then there's no reason for the shares to go down in value. So what is the chance of that 2% devaluation? Now we can all say, well, obviously it was quite high, but that's after the event. So it is difficult, and you can get deceived. And I can talk to you a bit about how people actually work this out, because my firm works in that. But the point is, risk is inherently, especially tail risk, just for those, who aren't completely familiar with this jargon, losses in banking tend to have a distribution like this. It's kind of beta distribution. So they've got a limit, natural limit. The minimum loss is 0. The maximum loss is the whole caboodle. But so you've got so the tail. This is the tail, right? So this is the average is known in banking as the expected loss, and these are the tail losses. Now the problem with the tail losses is that, by definition, and this is the Nicholas Taleb point, you've got very few observations. So you don't really know what the probability is. You're trying to say, we've got a certain amount of capital, let's say it's 20 billion. What's the chance that we're going to experience a loss that wipes that out? Well, let's look at, how many kind of losses of that scale have there been in history? Well, there's been 1 or 2 here and there. It's really hard that's not conclusive evidence about what the probability is. So let's just call that the opacity of risk. So that's again kind of human failure. I don't mean but it's unavoidable human failure. I'm not saying anyone's done anything wrong, it's just really a challenge. Then another possibility for why the cost of equity didn't go up is something I've already mentioned, which was the compliance mentality, that complacency. It's all regulated, it must be okay. Right? There are all these regulations, we've satisfied the regulations, we've got the amount of capital, it must be okay. So it's holding these shares. They know that the banks are regulated. They know that they're regulated with regard to their solvency. So they don't worry about that. And the so-called analysts, now analysts are the people who work for the banks who talk about the value of companies' shares. So they give you advice about should you buy or sell, especially to institutional clients. They don't care about solvency. They care about short-term profits. So if you read their reports and so on, they're obsessed with this year's earnings and so on. This year's, so it stops them. They don't care about this part of the probability distribution. They don't care about the tails. They care about volatility around this year's earnings. So these are all kind of human failings, some avoidable, some unavoidable. I think there's one other thing, though, that could really have been working in people's minds, which is a kind of regulatory failure. And it's a phenomenon that got the name of the Greenspan put. Have any of you heard of this? So I don't know why it's called a put, actually. Put option is an option to sell. But anyway, whatever the reason for that name, what it refers to is the idea that should things start getting a bit rocky in the economy, especially for the finance sector, the reserve banks, the central banks, the Federal Reserve and so on, will intervene, pump liquidity into the market, and she'll be right, as we say down under. And of course, they've got a lot of reason to believe that. That exactly had been the history. And so that, I think, engendered a certain amount of what you might call institutional complacency about these kinds of issues. So I know we're running close to the wind, but don't worry, the cavalry will come to the rescue before it's too late. And indeed, they were kind of right. It did happen, and they're still making huge bonuses and so on. So that could be one of the reasons why shareholders were a little complacent, although shareholders have lost a lot of money. But I'm not, so that's the best I can do. I'm really not sure why the cost of equity didn't go up sooner, didn't respond in a kind of incremental way. As the banks are taking more risk, why share prices didn't react, didn't go down, I really don't fully understand. I think the complexity of banking, the opacity of the risks involved, maybe also kind of institutional you've got to remember, a lot of shareholders nowadays are pension funds and so on, and they're kind of pretty complacent kind of investors. So there's a lot of, I wish I could tell you more. I haven't heard any really good analysis of this. But that's as far as I've got with understanding what happened. But that doesn't, but even if we have a failure to understand exactly what happened, it doesn't follow that regulation is the answer. So, I don't see how regulation could solve this problem particularly, as I've set it up. But let's have a look at sorry, I'm taking too long, I'll do this quickly. What has been proposed. Now, the first thing I want to talk about is, very quickly, is there's kind of this popular analysis, which is really so farcical that if it didn't make me crazy, I would laugh. But so, if you think, what have been the targets post-crisis? One was short selling. So there was a ban on short selling banking shares. Short selling had nothing to do with the crisis, nothing whatsoever. The share price of the bank should have come down earlier. Had it come down earlier, things would have been much better. We would have a market signal. The crisis was caused inside the banks, nothing to do with the price of their shares once things started going wrong. Short selling got nothing to do with it. Hedge funds. Hedge funds had absolutely nothing to do with this crisis. Hedge funds, some of them did very well. They're intrinsically volatile because some will do well, some will do badly. There are thousands and thousands of them, all taking different positions. Hedge funds had no role in creating this crisis, yet they've been kind of targeted in the popular press. Effectively, what's happened is people have gone, oh, this was a failure of risk. Therefore, anyone who's kind of risk-taker is to be pointed at and blamed, even if that particular kind of risk-taking had no connection with the crisis. So short-selling, hedge funds, proprietary trading, Obama's new rule against proprietary trading has been picked on as well, all have been much discussed, yet they had no role in the crisis whatsoever. And the other one is bankers' pay, the way bankers are paid. I won't go on about this a bit. I've written several articles on this, a couple in the FT and one in Australia. So you can look them up if you want. But the proposals, I'll just briefly mention one proposal that is really counterproductive. It's the idea being that you should have a so-called clawback or a time lag on paying bonuses. So, just to give a concrete example, suppose you and I are both loan officers in a bank. We make a $10 million loan to a company, and we're going to get a bonus for that, right? It's a certain amount of profitability, I'm going to get a certain percentage. Now, we shouldn't get the bonus when we make the loan, the new idea goes. Instead, that bonus should be paid only when the loan is repaid, when we know that they didn't default. Now, suppose that you and I, we both make a loan to a BBB rated firm. It's got a probability of defaulting, according to that risk assessment of, I think BBB gives it about a 0.5% chance of defaulting in 5 years or something like that. Now, suppose yours does default and mine doesn't. I get the bonus, you don't. That's what that says. That's what the rule says. That is not risk adjusting. That is luck adjusting. Because when we make the loan and the deal is done, we had all the same information. Yours is BBB, mine is BBB. We've acted in exactly the same way. All that has happened is that, for things I can't control, mine's not defaulted, yours has. Now, what incentive effects will this have? Well, if I'm going to adjust the measured performance, your measured performance after the event, not when you make the loan, but after the loan is repaid, I can't also do the way you should risk adjust, which is to have a so-called capital charge at the point where you make the loan. That would be double counting, right? I can't both force you to pay a kind of insurance against the risk of default and then force you to cough up when they do default. That's double charging you. So I'm going to have to not have the insurance. You just pay if things go wrong. That removes any risk incentives you have. Because suppose I say to you, okay, you can make this loan, but if it goes bad, you're going to have to pay up. You'll make it, right? Because the chance of it going bad is 0.5%. You'll make the loan. If I charge a risk premium at the time you make the loan, you might not make the loan, right? Because it depends what the risk premium is relative to the amount you're going to earn off it. So this, what you might call wait-and-see approach, will in fact take away any constraint on risk-taking, because the probabilities of banking are so small of default that you will always think it's a good deal. It's insane. It is a truly insane proposal. It will increase risk-taking, not decrease it. Most of the ones around pay are insane.